Okay, click on check. Welcome back, everyone. Okay, sound seems to be good from my side. And there are a lot of questions regarding the market tonight, but we're not going to be looking at the market tonight. It's going to be an educational session, so it will be a learning webinar. So we're not going to be looking at the market. I don't think we have the time for that. But any questions regarding what we're going to be talking about on the webinar session tonight, then I'll be more than happy to answer that for you. Okay, so welcome back, everyone. This is Vito and Henjoto, and we are going to be covering the basic technical analysis tools. Now, when we talk basic, this is basically your ABC 1, 2, 3 in trading. If you're not able to do this, then unfortunately, you are going to have a hard time in charting, or if you want to be able to look at what the charts tell you and you don't understand the session tonight, then it's going to be tough. So we are going to cover the basics. These are going to be your fundamentals if you are going to be looking at charting. Okay. So just as usual, we are going to talk about the general advice and risk warning disclaimer. Note that any advice given is deemed to be of general nature, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. We do not offer signal service, managed funds, or other personalized advisory services, so please be aware of scams that promise guaranteed returns or managed accounts using my face, my name, or maybe OctaFX, because those services are not available and will not be offered. Okay. CFDs and Forex are leverage products that carry a high risk level and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. All right, so last week we went through about 40 minutes more than the allocated time, so I'll try and keep it in the 1 hour. Okay, so these are what we're going to be talking about tonight. We need to understand what support and resistance is, what it really is, correctly drawing a trend line, because a lot of people don't have the basics and they messed up drawing the trend lines and then getting all sort of wrong results when it comes to trading. I'm going to talk a little bit about chart patterns, focusing on continuation patterns tonight. So we are going to talk about triangles, pennants, flags, reversal patterns. We only have time for wedges tonight. I'll show you a little bit about head and shoulders if time permit, but that's going to be reserved for in-depth chart patterns webinar, which is coming as well. Okay, so let's kick it off. Let's talk about understanding support and resistance. So what is support and resistance? It's basically a price level that has to be of a strong significance, right? Typically, we talk about psychological price level. We are going to talk about that. And then we have Fibonacci levels. That's going to be in a separate webinar specific for Fibonacci. Pivot levels. This is something that I provide every Monday for the 4 currency majors on the weekly outlook. We are also going to consider the previous failure or bounces. They can also be categorized as support and resistance. So it's basically what you see in the picture here is a little bit of a tug of war when price hits a support and resistance, because buyers and sellers are basically attempting to wrest control from each other. So it is going to be a key significant level, and hopefully by the end of this webinar, you will be able to figure out what are those key levels, what you should be watching out for, because not all levels are the same. Okay, so this is an example of Fibonacci levels as a support and resistance. Typically, we draw from a swing high to a swing low to project the potential resistances in the market. And if you take a look at the picture here, those key levels are going to provide a little bit of a resistance, but this is just going to be a brief example. I'm not going to go into too much of a detail into Fibonacci as of yet. Again, this is for basics, right? Either you're really new, this is going to be useful for you, or if you have been trading but you're still a little bit confused in terms of how to properly use a trend line, what is it really for, and stuff like that, this is a webinar for you. Fibonacci, we're going to cover that in a separate webinar. Okay. So this is probably the most common support and resistance. It's basically your previous key level as a support and resistance. Let me see if I can get my pointer out. Just let me get it. Okay. Trying to figure out how to get my pointer out. But anyway, on the left where you see the red circles there, those are the previous resistances. Now we know so that this is going to be a key resistance, or basically a key level that's going to act as a resistance and support, because the market failed to break above that level. In this example, it's actually at 1.0525, and it goes to show how old this screenshot is, because this is Aussie USD trading above parity by 5 cents, right? So you can see that there's actually 4 attempts to break that resistance level, and then it finally break above it, and the market comes back to test that level as a support before it continues to bounce off. So if you look at previous key levels in the market, we're talking about previous support and resistances. So in technical analysis, especially in price analysis, it's always going to be what happened in the past and how we can actually use it in the future or in the present. That's basically the key things to understand tonight. Okay, so this example of support and resistance is typically a resistance turn support or a support turn resistance. That's the perfect example or the perfect scenario. You are probably going to be looking at this and the Euro USD at parity right now. If you open up your chart, it will be at Euro USD at parity at $1. That's basically a key level, and part of the reason is, if you take a look at this one, the level itself is located at 1.0525, and 25 does carry a high significance when it comes to trading, because it is a psychological level. We are going to talk about that soon. Okay. So here's a quick example. That was the hourly. This is on the 15 minutes time frame. So take a look at this one here. We have a support trend line, and then we have 2 swing lows that's really strong there. We see market bouncing off. It's really significant. I didn't take the second one because the second one, it's very close to the third swing low here. So if we notice a swing low or a swing high, and we draw a horizontal line, that line in the future is likely going to act as a potential support. So in this case scenario, if price breaks below the support trend line, then the next available support level is going to be this one in the middle here, and then the last one at the very bottom there. So this is basically what happened. Market breaks through it, it bounces off the first support, comes back to test the resistance trend line, and then goes lower, and finally breaking the last support line, and then eventually market does come back to test it as a resistance again. We are going to take some live example in the market after this quick slideshow sessions. So if you look at this slideshow and you have any questions, maybe you want to reserve it when we take a look at the market there, or during the Q&A session, and you can fire it up there. Okay, so please, no questions regarding the outlook of the market. We're not doing a live market outlook or a live trading session today. That's my session is going to be on Wednesday, so we are reserving Friday for educational session. So yeah, if you guys can refrain from asking about what the market is going to be doing. I know it's a huge day. We've got Jackson Hole Symposium. In 2 hours time, we'll have Jerome Powell talking about what the FOMC is going to be. So it's definitely, I understand your pain with what's going on in the market. There's a lot of indecision, but we are going to reserve this for the educational session first. Okay, so that's our first priority. Okay, so I'll probably need you guys to take a screenshot of this, or maybe jot it down or something like that, because not a lot of people actually know about psychological levels in the market, and especially not beginner traders. So I want to talk a little bit more about psychological levels in the market, because human traders, we are human traders, obviously, unless we are using algos. That's a completely different story, but I'm assuming we are human and we do our trading manually. We are actually psychologically conditioned to simplify numbers, including prices. So if I were to give you an orange, you are, sorry, maybe an orange. Oh yeah, you know what, different oranges in different country. Maybe Mandarin is still an orange. All right, I'll take an apple, for example. If you want to cut an apple, you know, probably 99% of people is going to cut the apple right in the middle, cut it into half, and then that half is cut into quarters. All right, that's just how human beings are psychologically conditioned to look at things. It's either a whole number or it's divided equally into some parts, right? That's basically how we think. So this will actually result in rounding down or up to the nearest number that could easily be remembered. If I were to say, okay, hey, you got Euro USD support at 99.45, or Euro USD support at 99.66, right? You're either gonna round up 99.45 to 99.50, so you can easily remember it. If you got 99.35, for example, you're probably gonna round it down to 99.25 or round it up to 99.50. If it's 99.60, you're probably gonna round it up to 99.75, because there are four numbers that's easily remembered, and these are your psychological price levels. It's basically any price levels that ends with 00, the double zero, 25, 50, and 75. So equal division, right? We've got the four numbers representing 4 quarters of a cent. Simple as that. So every 25 pips, we are going to condition ourselves to round things up or round things down, and that's basically what people are going to be remembering it. Okay, so if I were to look at maybe I personally look at more than 10 different instruments in one day, I'll just pick a number that I can remember and jot it down quickly. So if it's very close, if it's 0203, I'll just round it down to 00, right, and so forth. So significant support and resistance level are actually often found in close vicinity to these levels. If you don't believe me, you can mark 0025, 50, 75 on your charts, and you'll actually notice that, you know, that's basically where price bounces off, or that's basically where the key support and resistance is. So understanding psychological level, I think it's key. It's just that a lot of people are not given this knowledge. It's really more of a common sense than anything else. Okay, so this is a chart from October 7, 2016. I took a screenshot of this one here highlighting the Aussie USD. We've got 77 cents, 76.75, 76.50, 76.25, 76, 75.75. You'll notice where the highest swing high is. It's actually capped at 77. It actually never break through above 77. Where it bounces off before 77 is actually 76.50. Where it bounces off again, 76, and so forth. So if you start drawing a horizontal line every 25 pips, you'll actually be able to see the potential support and resistance in the market. Which one is actually more significant is actually going to be quite obvious to see. Okay. So yeah, again, I'm not going to be talking about, you know, the market right now. So it is an educational session. So please be respectful to those that come in to actually learn. Please don't spam chat on asking me what the euro is, where should gold go, and stuff like that. If we have time for it, we'll talk about it, but right now we want to focus on the educational side. Okay. All right, next up is pivot levels. Pivot levels is something that the weekly pivot levels, I gave that out every Monday on the weekly outlook. So pivot levels again are significant price levels that's actually calculated based on the high, low, and close of the previous period. So if you are looking at the hourly pivot, it's going to be calculated based on the previous hour. Typically, we look at the daily pivot and the weekly pivot, and that's calculated from the high, the low, and the close of the previous day or the previous week. So not only does it provide price levels to work with, but it also gives a range estimate of the trading day or the trading week. So from what happened yesterday, we can actually start measuring our potential targets or potential stop losses today by using pivots. It kind of gives you an estimate on how volatile the market is going to be, if there's any potential breakouts or the market is going to go sideways. That's how we use pivot levels, okay? The logic is pretty simple. When the market is trading above the pivot level, then it's considered to be bullish. And when the market is trading below the pivot level, it's considered to be bearish. It's also accompanied by support and resistance levels, which will be referred to as R1, R2, R3, potentially even R4. You can calculate out whatever you want, but we typically use R1 to R3 as our potential range for the day. Support 1, support 2, and support 3. Daily pivot is commonly used amongst traders to estimate the daily range and also to locate potential turning points in the market, which carries a strong significance to short, medium, and long-term traders. Okay. So even if you're trading on the 50-minute basis, you are probably going to be identifying yourself with the daily pivots. That's just how it works for a lot of traders. Okay, swing traders probably going to be looking at daily pivots as a potential bounce or breakout levels, and longer-term traders are probably going to be using more on the weekly pivot. Okay. So this is what a pivot level is. Again, this is taken October 7, 2016. It's on the pound USD on a 60 minutes time frame. So it is an old chart, but it still represents a good idea of what a pivot is. That's that. And then this is what's taken today. Okay, so if you take a look at the Euro USD, and these are daily pivot levels. You can see where the market is capped. So initially, market is trading below pivot level. It never breaks through support 3, and then it finds resistance at support 1, and so forth. So you can actually see that this pivot levels actually contain the market most of the time. Out of these 10 days, there's only one day, on the 4th day, that it actually break below support 3. And also on the 6th day where it actually breaks below support 3. So we can kind of estimate the range, but it's not a surefire thing. Most of the time it will be contained in the market, and typically if you take a look at how the market is containing it, it typically never exceeds support 2. Most of the time it'll actually find resistance and support at resistance 1 and support 1. Okay, let me pause for a bit and look through the chat if there's any question here. Okay, again, I'm not going to be answering things about if you want to know what the outlook is today. Why don't you draw the first and the second swing low? I'll show it to you when we talk about guidelines in terms of drawing trend lines. Hi, AMZ from Nigeria. Isolated girl, we're not going to talk about anything market related. Okay, is there a way we know that is a strong support resistance where if it does break, the price will go nuts? Yes, we can identify those, and Albert, you should know this very well. You should know your triangles very well by now. And is there a way to know which one is strong or weak support resistance? I think the way we look at it is this. If there's no correlation to the past, then it's not going to be a strong support and resistance. Okay, we'll talk in depth a little bit more about that later on. Okay, so let me give you a little bit about support and resistance tips, what you need to look out for. Do not limit yourself to one time frame, especially in a trending market, because in a trending market it's very easy for support and resistance to get broken. A broken resistance normally becomes support and vice versa, so maybe you need to take a look into that. I normally don't like to chase trends unless the momentum is right. We talked about momentum last week. Was it 2 weeks ago? I'm pretty sure it was last week. Anyway, if there's no momentum behind it, I'll just wait around, because any breakouts, typically we get a retest. I like a retest because that's going to minimize my stop loss. It's going to maximize my risk to reward ratio. Okay, you also need to analyze price movements around support and resistance, so you can't just identify, hey, we got support and resistance today and it'll carry any significance. No, it doesn't work that way. You actually need to look at past price movements, like, for example, the gold. All right, someone asked about gold, so I'm just gonna answer a little bit about gold. Notice gold, you'll find a little bit of support and resistance coming in around 1750. It just hovers around that, then it's very hard for it to get above 1800. To be specific, it's actually 1795, because that was the key levels since last year. Okay, so we are looking at past price data to actually figure out what the market is going to be doing. I'll give you a very simple explanation at a very simple logic at the very end of the at the very last slide of this webinar. So if you want to know the logic, hang around. Okay, and there's also different type of instruments or assets. It'll act differently to support and resistance, right? Because we got some instruments that break and retest support and resistance, some break and proceed straight to the next support and resistance level, like the pound USD. Typically it breaks and it runs. We got dollar yen, Aussie USD. Typically it breaks and it actually retests. Okay. Some obey Fibonacci levels more than the previous support and resistance, like pound, for example. We also got range bound instruments that tends to bounce off support and resistance instead of breaking out of it. Trending instruments will tend to break out and then retest those support and resistance. Ranging instruments typically stays within the range and find sellers and buyers at those support and resistance. But this is more on the experience side. So if you understand this, you implement this in your trading. Learn from it, because what you're trading, I don't know what your preference is, so I'm just going to give you a general guideline. Also, you need to be aware of hidden support and resistances, like psychological price levels. Like I can pop out Euro USD right now if you want me to. This is the Euro USD. I've already drawn 1.0025, so 25 pips above parity. Notice how it's capped at 1.0025 because that was previous support, turn resistance. Okay, now we scroll back a little bit further. Notice where 1.0025 was. It was basically just a cluster of a market that goes sideways. That's actually between parity and 1.0025. So that's how we identify support and resistances. How the market pivots around 99.50 because the low back on 14th of July, where it actually break below parity, was actually at 99.50. So that's where you actually find the current support or the range for the Euro USD to be bouncing between 1.0025 and 99.50. So that's how it works. It's not just looking at this and then, oh yeah, I get where my resistance and support is. It doesn't work that way. You actually need to zoom out. You actually need to find out if those levels actually carries any significance in the past. Okay? So that's how we look at it. And then, throughout the webinars or throughout the outlook, I talk about 99 cents as the potential low on this one. Why 99 cents? I don't know, because market has never been to 99 cents recently. But 99 cents, it's a psychological price level, right? It's 99 cents. It's 1 cent below parity level. And that's basically what the market does this week, because people that trade, they'll just relate to, okay, a psychological level. If I'm shorting Euro USD, where do I get out? I don't know where I'm getting out, but I like 99 cents. It's easy to remember. I like 99.50. It's easy to remember. So people get out at 99.50. They get out at 99 cents. A very simple logic, and that's where you see market bounces off from these support levels or resistance levels. Okay, so that's the logic behind understanding support and resistance. You know, I can draw 99.80 if someone says 99.80, because I'll be honest with you, I've been following the Telegram channel. You know, a lot of people are talking about, hey, the signal is wrong, the signal is right, and blah blah blah. To me, it's why do you want to listen to other people's signal if you don't understand what the market is? The best way to trade is to understand what you're doing, because this is not some child's play. This is serious. Business trading is like a business. If you don't take it seriously, you know, make some effort to understand how you actually look at the market. So if I draw 99.80, doesn't carry any significance, right? What does it do? What does it say? It doesn't really chime with anything. What's going on with 99.80? Nothing. Price never bounces off 99.80. Price just goes through it without any significance. So you can't just take a random number and say, oh yeah, it bounces off. So right now there's a swing low on the hourly time frame. You're probably not going to see this as a swing low, because you're not going to pick it up on the hourly time frame. You're not going to look at it as a swing low, but it's at 99.85. What is the significance at 99.85? Right, on the 15 minutes time frame, you're going to look at it. Oh yeah, that's a swing low. Yeah, you can use that as a range breakout, but is it a support? Yes, it's a support. Is it significant? Does it carry a bigger? Does it carry more a larger significance compared to parity at $1 or 99.50? It doesn't do anything, right? So we're not going to look at numbers where market creates a swing high or swing low and call it support and resistance. That's just wrong. Okay, so let's go back. Hopefully that helps. All right. Always look for a confirmed close. That means if you're trading on the hourly time frame, you need to see price close above a support and resistance before considering it as broken. You know, some people think, all right, yeah, support and resistance are broken when price goes through it. No, it doesn't work that way. Price actually has to close beyond it, right? It has to close above a resistance trend line. It has to close below a support trend line or a support level. You know, price breaching support and resistance doesn't mean that those levels have failed or been broken. We call this market spikes, right? So always identify multiple support and resistance to get a better projection of the market, like how I did with the Euro USD just now. I'm not looking at one key level and then be happy with it. You know, I look at like 4, 99.50, 99, $1, $1.25. I look at 4. So if you take a look at this one here, where price actually goes above 1.0025, do you call this a breakout? No, it's not a breakout, because price actually has to close above. Okay, so it actually has to close above it. Now if I zoom in and simulated candles, right, this one closes above it. That's where we know the support or resistance is likely gone. That's what we consider to be a breakout. This, let me just change it to red, is not a breakout. That's just a spike in the market. It means nothing. Okay, so get it right, because people are reading signals wrong because they don't understand the basics of reading the chart. So get your basics right, and at least understand what people are saying before you follow their signals. I think that's basically the whole idea. Okay. Buying and selling a support and resistance, again, might seem like a good idea. We talked a little bit about this on Wednesday, last Wednesday. If you want to watch that video, just watch the live market outlook on Wednesday. There was a question about selling at a resistance trend line. Might seem like a good idea, but it actually carries a high risk without confirming the bounce or rejection or breakout with any other indicators. So if you're just waiting, right, like in the case of Euro USD here, what about, yeah, you know what, how about I buy it I plan to go long when price goes at 99.50, and I'll just go long. And maybe I'll put my stop loss here. Oh yeah, great, 5 pip stop loss. I'm going to target 1.0025. It's illogical, right? Most of the time the stop loss is going to get hit first if it doesn't show anything significant. All right, we got data, personal income, but we are going to skip that. Numbers coming in, consensus reported with 0.1. Numbers coming in bad for the US number, but again, it's so close to Jerome Powell, market's probably just gonna wait for it. Okay, so let's get back. So again, buying and selling at support and resistance might seem like a good idea, but it does carry a very high risk without confirming the bounce or rejection or breakout with other indicators. Mainly if you don't understand momentum, don't do that. I'll only have one word for it. It's actually stupid. Okay, so don't do that. If someone says, oh yeah, sell it because it's at resistance, you know what you're looking at before you actually follow those ideas, because again, it's a very harsh word, but I need to lay down the foundation here. It's actually really stupid. Okay. Again, for breakout scenarios, the better probability for a trade would come after a retest of those levels. So if you are late to the breakout, just relax, let the market run. It'll probably come back to test those support level. You'll get a better entry, you'll get a better stop loss, you'll get a better risk to reward ratio. So, as I say, if you don't feel comfortable, don't do it. Simple as that. And always don't rush into things. Just relax. Nothing is ever too late with the market, especially in FX or the CFD markets. There's always going to be opportunity. You just need to be patient, and you just need to be logical about it. That's very simple. Okay. All right, let's talk about trend lines, because I've seen really bad explanation of trend lines. I've seen so-called experienced traders or maybe a mentor or whatever talk about trend lines, and they still get it wrong. So I'm gonna lay down the foundation. Hopefully this makes sense. I'm not saying I'm super right, but this is basically the basics of it. So I think we all should get it right. It's like 1 + 1, you don't get 3, it's 2, right? Okay, or 1 + 1, you don't get 11. But some people actually look at 1 + 1 and say it's 11. I don't know. Okay, so there are rules to follow when drawing a trend line. Trend line basically just provides you with the guidelines of price movement. For price movement, whether it's actually trending up or trending down. That's why it's called trend lines. It can actually act as a support or resistance. Trend lines are going to be sloping, and the degree of the slope indicates the strength of the trend. Very simple. You want to know the degrees? If you draw a trend line, you'll get 30 degree to 45 degree, then you get a normal trending market. If you got anything that's above 45 degree or anything closer to 90 degree, then that means it's actually a short-term outburst. It's just a short-term burst. That trend is not going to last long. You want a long-lasting trend, the number is actually 30 to 45 degrees. Okay. So let's try drawing support trend lines. What you want to look for when you want to draw a support trend line, you want to be looking for swing lows on the chart. And you basically want to connect the low and not the close of the period. So connect the first two lows, and that's basically it. A support trend line that must then connect through 3 swing lows to be actually confirmed as a support trend line. So that's actually the part where you actually draw, and then there's the part where you actually have to wait for the market to confirm it as a support trend line. But sentiment-wise, it basically just tells you that there are more buyers than sellers in the market, because people are willing to buy at higher prices, not really want to sell their positions. Okay. So again, very old chart. This was taken in 2011 or 2012, I believe. But you basically want to connect the lows. Notice the second one there. You might think that I should connect it to the blue candlestick. No, it's not. There's actually, I'm connecting it to the red one. Okay. I'm just new to having the PowerPoint in one small window, so I where's my laser pointer? I'm trying to get my laser pointer out. Anyway, So connect two dots, you'll get the third retest, and that basically confirms the trend line. If there's any break below it, it'll come back up as a resistance. So if you draw a support trend line, it'll potentially become a resistance trend line. So if a support trend line is very significant, I'm actually going to leave that trend line, or I'll actually come back to it in the future, because it might act as a potential resistance without you knowing it. Okay. So here's a quick example, probably a really good example. This is again taken October 7, 2016. So yeah, connect two dots, sorry, 1, 2, and then you'll get the third one. You'll understand when it becomes significant. And going forward into the future, it'll potentially act as another support resistance as the market goes, okay? So maybe in the example of probably Euro USD is not a great example. Maybe I'll take dollar yen. Let's say you're looking at the dollar yen right now and you have this on the daily. You are actually going to connect this to this, right? The question just now was, why wasn't it at the red one, for example? Why wasn't it at 132? Because I connected at the very end of it. I'm looking for the low of things. So don't draw trend lines like this. It's just messed up. Please don't do that. It's actually heart-wrenching, gut-wrenching, heartbreaking if I see people draw trend lines like that. It always has to be from the lowest point, which is the swing low. And then simple, you can just then extend the line and you'll get a support trend line. And then we'll talk about the degree. It's actually around 28 degrees. So this is actually a really good support trend line for the dollar yen, right? So that's how we do a support trend line. Very simple. Okay, let's go back. Next up, if we want to draw a resistance trend line, we want to be looking for swing highs on the chart. You want to connect the high and not the close of the period. Again, the very extreme, right? A resistance trend line must connect through 3 swing highs. Okay, same logic. This indicates there are more sellers than buyers in the market. We can take a look at this one. You got 1, 2, 3 tested as a resistance trend line. You can keep that trend line if you want to. Okay, another example here. We got 1, 2, 3, and then going forward into the future, you'll notice this. This is on the daily for the euro yen. Again, this is on October 7, 2016. The trend line was actually confirmed in April, and it's useful for pretty much the rest of the year, right? You'll notice this is a really old chart, because if you take a look at where the the euro yen is, where is it right now? It's it's very far from where we are. Okay, so yeah, let's stop here and how to draw trend lines with mobile. Kelvin Uchenna, is the screen not bright? Hey man, I don't know your screen. I'm using full screen. Probably one of the best monitors that I have around here. So yeah. Okay, so that's pretty good, yeah. We talk about pivot levels. Not seeing the pointer. I'm also not seeing the pointer. I'm trying to get the pointer out. But yeah, look, I'm very sorry. I'm using a 4K screen, so I'm really only using one small section of my screen here. But yeah, bear with me here. How do you combine pivot levels and support and resistance to determine possible market movement? Very good example. Very good questions. That's something that I actually use every week. So something like this. This was on oil. I think this was a question that was asked on Wednesday. How do I combine it? So I'm actually using pivot levels for the oil. This is a weekly pivot level. So it's trading above the pivot level. It broke through resistance 1, it broke through resistance 2. And at the same time, we have a psychological resistance at 95 and also the high on 11th of August. So you can always combine it. If a lot of these levels are very close together, then you are going to get a really significant support and resistance in the market. Okay, very simple. Okay, so let's go on. Let's talk about chart patterns. So we got 2 major categories of chart patterns. We basically have continuation patterns. We got reversal patterns. These are going to be the 2 main categories. Obviously, you got your neutral patterns, so like the rectangles, symmetrical triangles, and stuff like that. But you know, typically it falls into one or the other. Most commonly used chart patterns are triangles, pennants, flags, and wedges, and these are the 4 things that we are going to cover tonight. The main use of chart patterns is actually to measure sentiment in the market. As we go through topic by topic, you're going to get a clear understanding of how do we actually look at these sentiments. Okay, you can also use it to time an entry. You can also use it to detect potential reversals or potential trend continuations in the market if you use chart patterns. All right, first one, it's triangles. It's formed by a support and resistance trend line. So let me give you an example. Right, let's take a look at the dollar yen here. So you know, you take a look at this one here. We only been drawing a support trend line, but you can actually draw a resistance trend line as well, right? So if you take that and that, you get your resistance trend line. We actually just broke above symmetrical triangle, right? So if you draw a support trend line, a resistance trend line, it will always form a triangle. Okay, that's the beauty with triangles. You know why? Because there's always going to be a time limit or validity of a triangle when the resistance trend line and the support trend line meet. Okay, when those 2 lines meet, that's the end of the triangle. Triangle are finite, it's not infinite. Okay, a parallel channel might be infinite until one side it gets broken, but a triangle, no matter what, price is going to get pushed out of it eventually. So there's always going to be a time limit when we look at triangles, and that's what I like. You know, people look at, you know, potentially Euro USD could break out before this. How do we know the before? Because we can actually define the end of the triangle. Okay, there are going to be 3 variations to a triangle. There's going to be an ascending triangle. This is a bullish continuation pattern. You got a symmetrical triangle. It's got a neutral stance to it, so it could be a continuation or it could be a reversal. And then we have the descending triangle. It's a bearish continuation pattern. Typically it appears in a downtrend. So a triangle will always exist at all times if you identify this through different time frames. So I'm actually going to prove it to you right now. Okay, so we got this on the daily, right? Very simple. We just broke above the triangle. You know, if we go into the hourly time frame, do we actually see another triangle right now? Because we actually do, right? We got this, which we just broke above. We got this that acts as a support. So if I zoom out, it's actually a triangle and then another triangle. So it's always going to be in a triangle. It's just different time frame tells you different triangles. So yeah, you need to identify which triangles you want to look at. But typically market is always going to be contained within a triangle. It's just dependent on time frames. Okay. So yeah, triangles can actually be used as an entry or exit to the market. And in terms of entry or exit, I like using ascending and descending triangle. I don't really like symmetrical triangle a lot. It could be great, but because of the nature of it, it's a little bit tough. There's no underlying trend typically to kind of justify if a symmetrical triangle is a really strong breakout signal. Okay. So yeah, triangles will typically happen before a certain breakout. All right, if you take a look at the market before a major move happened, it typically stays within a chart patterns. Could be a flag, could be a triangle, mostly a triangle, or it could be a wedge, for example. But before any major move in the market, before any breakout happened, it typically goes and form a chart pattern. Very simple logic. Because we are looking at a breakout, there's always going to be momentum behind it. Okay, so the first one is ascending triangle. It's commonly found in an uptrend because it's a continuation pattern. It signals trend continuation. The flat top or the horizontal line capping it, that's what we consider to be more of an overbought condition in the market. But even with the overbought condition, the sentiment is still bullish and buyers will continue to buy on dips, right? Buying on dips, if you don't know what it is, if the market is so bullish, any drop in price, buyers are just going to come in and pick it up. Okay, so that's buying on dips. Okay, there's also going to be strategies on buying on dips. You don't just randomly buy on the dips. But there has to be a logic behind it, and typically you need to know the momentum, like what we talked about last week for you to actually understand the logic behind buy on dip. So if you missed out last week's webinar, please watch it because you need that as the basics in technical analysis as well. Okay. It will also commonly occurs around psychological price levels, capping the market horizontally, right? So we got this ascending triangle here. This is on the dollar yen, obviously a very, very old screenshot because the yen was still like 82, 83. Anyway, the ascending triangle happens very close to 83, okay? Then we got our support trend line here. And that's what we call buying on dips, right? Every time it touches the resistance, it comes back down and people buy it at a higher level. That creates that higher lows that forms a support trend line. Okay, so it will indicate a trend continuation when it breaks out, and that's where you know the trend's going to resume. So we got an uptrend, market pauses for a bit, this breaks out, and then you got your uptrend or continuation to happen. Okay. When it comes to the scenario of an ascending triangle, if there's a failure to break above the resistance, it's typically not a sign of reversal because you got support here. Typically the range support that's forming that ascending triangle. Okay, so like this scenario here, we got the ascending triangle, that blue line there, market breaks through it, comes back, tests the trend line, and then it'll just continue to go up. Okay, so that's very simple. So ascending triangle typically appears in an uptrend. It's a continuation pattern. It's a bullish continuation pattern. Yes, it's recorded, Elias, so you can always come back to it and watch it. And I really recommend you guys to rewatch it again as many times as you want because, as I say, this is the ABC. This is the 1, 2, 3 of charting. If you cannot get what I'm talking about today, if you don't understand the logic behind what I'm explaining today, then you're really gonna torture yourself. You're really gonna have a hard time going forward if you want to pick up technical analysis as your main methods of looking at the market. Okay, so that's ascending triangle. Next one is descending triangle. It's the opposite of that. It's bearish, commonly found in a downtrend. Signals trend continuation. Flat bottom means an oversold condition, but the sentiment is still bearish and sellers continue to sell on any pullbacks. Okay, like what happened with... I'm starting to feel really sorry for Euro USD, but yeah. All right. So yeah, take a look at the Euro USD, the progression downwards on the Euro USD. There's actually a descending triangle here that we can actually use. I'm gonna keep that. That's just for future contents that I'm gonna be making on FIPS. But if we take a look at this one here, 1.03. Sorry. That is coordinates 1.0350. Right? We can draw that as a horizontal support trend line. Yeah. And then we've got our resistance trend line basically all the way from there, it's capping the market. So obviously you actually have a descending triangle on the break below 1.0350. 1.0350 was, if you go onto the weekly outlook about 3 weeks or 4 weeks ago, that was actually the key resistance in the market. Okay. So as I said, if there's a breakout, don't worry. You know why? Because if it's significant like this one here, we got a descending triangle here. This is a really good example of a descending triangle in the current market, right? Okay, so we got a descending triangle. You'll notice the descending triangle, right? And then we've got the breakout here. Price goes below that support trend line. And then, you might be shorting it and you could be targeting the blah, 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 whatever. But look at what the market does. Market goes down. Eventually, market comes back and tests it as a resistance again before it goes down even lower. Okay, so that's kind of the logic behind support and resistance. And that's what I say, you don't really have to rush into things because if it is a strong support and resistance, market will come back to it. The problem is, some people maybe don't like waiting a month, right? But if you missed out on the first trade, what's the point of shorting it here, for example? Oh, you missed it, you short it here. and then you have to put your stop losses all the way up there. It's ridiculous, right? But if I were to short it here, right, when it comes back to test that, you know, that gives me a much better risk to reward ratio, doesn't it? Right? It makes a lot of sense. So as I say, don't rush. You know, a trade will come to you. I don't think you need to really chase after a trade, you know. So don't rush into things. We know the momentum is still pointing to the downside. We could potentially go short there. A lot of people did that. So no rush. All right. This is a very good example of a breakout in ascending triangle and a potential use of previous key level as future resistances, right? Previous support level acting as a future resistance level. So you understand the logic there. So you can go short on the breakout, you can go short on the pullbacks. So this is the scenario where I say, you know, sentiments are still bearish and sellers continue to sell on pullbacks. They look for opportunities to actually short the market. So currently it occurs around psychological price levels, again capping the market horizontally. You don't believe me? If that's the psychological price level, is actually at 1.0350. Okay, support level 1.0025, 1.0000, 99.50, 99. So get it. Just learn to live with it. You're gonna start looking at psychological price level nowadays after this session. Okay, so as an example here, we got a descending triangle, market goes down, you create a symmetrical triangle, continues to go down, create a descending triangle, and then it continues to go down. You know, you can there's actually 3 times you can actually jump into that downtrend. That's basically the use of continuation patterns. Okay, so here's an example on a potential descending triangle that hasn't break yet. If you take a look at the support trend line, again, this is 128.75, right? Another psychological price level. You look at the degree here, it's about 30-45 degrees. So you'll know that this is a good trend line, right? But market hasn't broken through it, but this is what we are looking at. Most of the time when we draw a descending triangle, ascending triangle, this is the current situation. What you're doing is you do not trade while price is actually within the triangle. You will only trade when there's a breakout, when price actually goes outside, closes outside of the triangle. That's when you act on those triangle patterns. Okay. Next up, we are going to take a look at a symmetrical triangle. It's neutral. It actually signifies indecision in the market when the market is confused, like the symmetrical triangle on the Euro USD that we talked about just now. It was a symmetrical triangle, right? It signifies indecision in the market because buyers and sellers, they have equal strength. But what's unique is that when we have a symmetrical triangle, range will actually gradually get smaller because uncertainty irks traders. That basically push them out of the market. Because as like me, if price is within a symmetrical triangle, I'll say, you know what? Hey, I don't need to open a position. Because why? I'm not comfortable. It's indecision. There's indecision in the market. Buyers don't have control, sellers don't have control. So I'll just be on the sideline. I'm just going to be on the sideline until a breakout occurs. So because a lot of traders think that way, a lot of traders move out of the sideline. That's why you got a reduced momentum. You got a reduced volume. You got a reduced volatility that diminishes as time goes by because people are staying out of the market. That's the logic behind a symmetrical triangle, right? Most of the time, the original trend will continue after a breakout, but, huge but, right? I just forgot to bold it here. But due to the nature of uncertainty, this could also be a reversal point in the market. So if you see a symmetrical triangle, don't just assume that, yeah, the market is going to continue. No. If you see a symmetrical triangle, you should be very afraid because there's indecision in the market. Market's very indecisive in terms of where the market is going to go. So if you look at it, found a symmetrical triangle, you need to be patient. Just don't rush into it, right? So a symmetrical triangle can appear anywhere in the trend, uptrend, downtrend, sideways, whatever. It will appear, right? Before a typical breakout, there's going to be a symmetrical triangle breakout before even a rectangle breakout. But we'll talk about rectangles later on in another session. But this is your basics, right? If you see a symmetrical triangle, it basically tells you that there's a consolidation in the market. There's market equilibrium. Buyers and sellers are not winning, right? You got your volume and volatility diminishing. The range just gets smaller and smaller. But there's always an end to a symmetrical triangle, so you'll know when it's actually going to end. Okay, so symmetrical triangle like this one here appears like that. Okay, this is on the US 30. You imagine how old this chart is. This is the US 30. This is Dow Jones Industrial Average when the high was actually at 18,636. Where is Dow Jones right now? 30-odd thousand. Right. Anyway, this is a symmetrical triangle. You'll notice the range gets smaller. The volume gets smaller. A lot of people are just sideline waiting for a breakout. You know, what's the point of trading this? Because you're not going to get your target level if you target a new high or a new low, because it's in a symmetrical triangle. The logic and the law states that there's always going to be a diminishing volume and a diminishing range. So just wait for a breakout. Okay, so triangles. Let me just, before we go summary, let me see if I can use an example. Pound USD, it's probably a good example as well. Let me draw this on Pound USD. All right, so this is Pound USD on the hourly time frame. I think we just broken out of that, so let's find out if we can actually see that on the 4-hourly time frame. Yes, so on the 4-hourly time frame we can actually see it's still within a symmetrical triangle, because we got a resistance trend line that slopes down, and then we also got a support trend line that goes up, right? You'll know when it ends, when it crosses over, when it meets, those two lines meets. So I can tell you the triangle is going to break out before the 29th of August, 9 a.m. New York time. Why? Because that's the end of the resistance trend line, the support trend line. That's where it meets. Okay. So this is a symmetrical triangle like the Pound USD right now. A breakout on a symmetrical triangle, you'll actually start noticing one thing. Can you use other resistance? Yes. You know why? Because you can actually use, there's actually a key level here around 1.1875, yeah? So yeah, let's put it on a psychological price level. We are going to have another resistance at 1.1875. So this is what I say when you look at support and resistance, you need to look at other things, right? Because we got support here building up at 1.1775. Sorry, 1.1750 actually, right? So this is the range. You know, even if it breaks above that resistance, above this triangle, it's going to find resistance at 1.1875. So you'll need to wait for a breakout. If you take that as a breakout trade, your risk is actually going to be this low here. So to give you an illustration, if you want to go long on this symmetrical triangle, your stop loss is going to be here. Maybe your target level is just going to be here. Is it worth it? No. So that's the kind of logic. If it does break above 1.1875, then yeah, you know why? You can actually use the range of this triangle as a potential target. So if you jump in on the breakout of this triangle, you want to be targeting about the same size as the triangle itself. So you only be looking at about 160 pips. Then it becomes a great risk-reward ratio, right? Your risk-reward ratio is going to be nearly 1 to 2. So it's going to be worth it. Okay, but you know, get the basics right, and then we'll start talking about this when we talk about in-depth chart patterns in the future. But today I just want you to relax, understand the basics of things. Okay. Okay. So I think we are going to have about an hour and a half session tonight. Triangle summary. Triangles are one of the best trade entries based on price. The momentum during breakout almost always move in one direction. Of being very close to support and resistance during breakouts, the risk-reward ratio are generally favorable as well. Okay, next up it's pennants, because pennants are basically triangles. That's accompanied by a pole stick or a flagpole from the flag patterns, right? We'll talk about flag after this, but since we talk about triangles, we want to talk about pennants here. So when we combine flags and triangles, basically forms a pennant, right? Basically, the combined patterns that start from the pole stick and end with the formation of a triangle are basically what we call the pennant. Majority of pennant that is formed will end in a symmetrical triangle. Trust me, about maybe 80% of the time when you draw a pennant, it's likely going to be in a symmetrical triangle. It basically has a neutral connotation. If the pennant, however, adopts a form of a descending or ascending triangle, and meets the same criteria as the ascending and descending triangle, the pennants will become a continuation pattern. So a lot of people say pennants are reversal patterns, right? Pennants could be a continuation pattern. So a pennant that's actually that ends with a symmetrical triangle, it doesn't mean anything. It carries a neutral position as well. Okay, so this is an example of a pennant. We see a really strong uptrend, and then the market goes into a sideways market condition that forms into a triangle. In this case, it is a symmetrical triangle, so it could break to the upside or it could reverse. Okay, next one is flags. In a trend where the market moves quickly with high volatility, momentum and volume, this is going to form what we call a flagpole. So when we look at a market that's rallying up or crashing down, that's basically what a flagpole is. That's basically what forms a flagpole. If the rally or that crash is followed by a formation of an almost parallel channel, not a triangle, that is against the trend, then we will categorize that as a flag. Okay? In the context of a strong upward rally, we call this a bullish flag. On the other hand, if the market is in a downtrend, we'll call it a bearish flag. I'll show an example of a bullish and a bearish flag, so don't worry about it. So from the name itself, a flag provides a continuation identity where the initial trend will continue and parallel pullback or retracement conditions become a time for momentum in the market to breathe, right? So if it's an overbought condition in an uptrend, when it creates a flag, it gives that momentum time to breathe. It'll reset the momentum before that breakout above that flag happens. Okay, so this is what we look at a bullish flag. We see a strong rally to the upside, and we have a parallel channel, and then a breakout happens, and then the market shoots up again. Okay, so we got a combination of a bearish flag and a pennant here. So we got market going down very strongly, and then we have a parallel channel that goes up slightly, creating a bearish flag, and then the market breaks down, create another pole, and then it starts forming a pennant, and then it breaks down again. So you'll start noticing this kind of things very, very soon once you have this in your head, right? You'll start noticing it everywhere. There are criteria to what is going to be called a flag. I'm going to give you a spoiler. But a flag cannot exceed that parallel channel, that pullback that we see here. It cannot exceed 20 bars. If it exceeds 20 bars, then we call it an ascending or descending channel. We'll talk about that later on, but those are something for you to learn. So flags and pennants is interchangeable. I'll notice that if a pattern appears, there's a little bit more uncertainty. If a flag appears, then it gives me a stronger probability that the market could be continuing its trend. I think that's the only main differences between a flag and a pennant. Okay, all right, last one we don't want to talk about wedges, because there are serious issues with wedges and people are actually using it left and right, using it wrong left and right. Wedges cannot be a continuation pattern. Wedges can only be a reversal pattern. It's very often used amongst equity traders and are accurate enough to provide a reversal signal in the market. There are two types of wedges, namely rising wedge, which is only valid when the market is in an uptrend, and then the falling wedge, which is only valid when the market is in a downtrend. So if you see a rising wedge at the very top of the market, then you'll know that the end is actually going to be near. Okay, so they are what we call a counter market indicators. Okay, so when they are formed, an uptrend will continue to push higher. It's just that it starts to diminish. Something is wrong with that movement. That's why wedges are actually counter market indicators and are a sign that a trend will end and change course. Therefore, The best wedge that you see is actually a formation that occurs at the end of a trend, right? Rising wedge is formed by support and resistance trend lines. See how important that trend line that we talked about earlier. You get that wrong, you're not going to be able to draw triangles, flags, wedges, blah 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 correctly. So you messed up on drawing a trend line. You draw a trend line incorrectly, you're gonna get screwed. It's just simple as that. Okay, so it sounds, very basic. Maybe you guys get pissed, I don't know, but to me, if you don't get the basics right, you're just gonna get everything wrong. That's just the logic behind trend lines. Okay, rising wedge is formed by support and resistance trend lines that are pointing upwards and are steeper in degree than parallel flags, right? This condition is only valid when the market is in an uptrend. So we call that a rising wedge. Rising wedge means the market is likely going to reverse to the downside. If you see a falling wedge, that's actually a bullish sign. That's formed by support and resistance trend line that is pointing downwards, and it's only valid when the market conditions are in a downtrend. So you'll see the market in an uptrend, it'll start forming a rising wedge and it'll crash, right? And then you'll notice that when it crashes again, a falling wedge appears, it'll start to pick up. Okay, so a good wedge appears at the end of a trend. It's just as simple as that. It's not going to be somewhere in the middle of the trend. Look at this one here. Seriously, I need to figure out how to draw this. But can you look at my cursor right here in the middle? What is that? That's actually a bearish flag following a rising wedge, right? So that's a continuation pattern. So again, the same thing here. You get a bearish flag before the market drops down again. So very, very simple. These patterns are everywhere. They appear everywhere. You're going to pick up one pattern after the other. So if you say the market is confused, the market is never confused. It's just typically within a pattern that you probably don't understand, or you don't realize what pattern it is. Right, and these four patterns are typically the most used patterns, the most understood patterns. I can go into like extreme patterns, I can go into cup and handles and stuff like that. But what's the point? Because you're not going to be able to look at cup and handles all the time. Okay, so as promised, this is why price action works. This is why chart pattern works. There's a logic behind it. Price movements are influenced by traders. Okay, because they're influenced by traders, then there's always going to be fear of failure around those psychological price levels. That's going to be a strong influence on the formation of a support and resistance. You'll also notice when it spikes, why does it spike? Why doesn't it break out? Because there's profit taking, right? If everyone is going long, it hits a resistance trend line. What's the logic? You want to take your profit, right? If you have a long position and you want to get out of your long position, that means you have to sell your position, right? So instead of going buy, you start shorting when you get out of that position. That is what we call profit taking in the market. Now, profit taking around psychological levels or around support and resistance levels are very common. Okay, that gives you the illusion of a strong support and resistance. It might not be a strong support and resistance, but if there's profit taking in the market, it might create that illusion, because you'll start noticing, oh yeah, the market turns around. The market doesn't turn around because the market wants to turn around, or it has to go down in a downtrend. There's always going to be traders behind it, or maybe algo run or coded by traders that says, you know what, hit this level, take your profit, get out. And the same. Here's the logic, right? Trend traders still want to ride the trend. Hence the continuation. Once traders are actually assured that a certain level has been taken care of, let's say a symmetrical triangle in an uptrend, I want to get out of it. You know why? Because I don't like that price is within a symmetrical triangle. There's a lot of indecision in there. But once it breaks out, I'll jump back in that trend again. Simple as that, right? Counter trend traders, on the other hand, actually hope for flat or horizontal level to work, and will go against the trend and have stops line up beyond these levels. Again, this was us, but let me give you an illustration. if without thinking, this is on the pound USD on the 4-hourly time frame, you look at the resistance, that's 1878. We round it down to 1875, right? I bet you right now there are people saying sell pound USD. All right, why? Because it's very close to 1875. So what they're hoping, see, I hate the word hope, because they're hoping that is actually going to fail at 1875, and then they're going to do this, right? That's just so ridiculous. Don't do that, guys. It's like catching a falling knife. I'll talk about this on last Wednesday. It's really, I don't really like the word when I do my webinars, but since this is a basic, just don't do this, okay? Anyone that does this without really understanding it, it's not in their right mind. Okay, how do you know the market's going to stop there? How do you know the market's going to stop there and then turn around? How do you know that the market's not going to break and then come back and test this and then bounce back up? How do you know, right? You kind of just guessing, you kind of, really assuming and hoping, yeah, let's have a pending order there at 1875 and let's hit it hard. Let's go short. That's why I don't do pending orders. You know why? Because I want to wait for confirmation. You know, what is my confirmation? My confirmation would be if it touches 1875, momentum turns around, then that's my confirmation. All right, if this doesn't happen and then momentum still points to the upside, you want to short at 1875, that's kind of suicidal, right? I might as well wait for momentum to go up. Okay, if it does break above 1875, then comes back down, then I'll buy 1875 over here, right? Have my stop loss here or here, you know, then I would target the previous resistance level around 1.21. You know, that makes sense, right? It will give me a good risk to reward ratio, 1 to 2. Well, what's not so good about it? That's the kind of logic you need to have when you trade with support and resistance. All right, and you know why? Because when that breakout happens, it's actually going to accelerate, because you got people that sell the market. They have their stop losses here. People that sell the market are going to have their stop losses here. All right, when stop losses in a short position gets hit, it means they need to buy. And that's going to speed up the run to the upside. That's what creates a breakout in the market. Okay, so to wrap things up, in summary, charting relies on past information to predict future support and resistance. So without looking at the past, you can't really identify support and resistances, because they need to have some strong significance in the past. Now, price takes into account trader sentiment and psychology as well. So, you know, we got the triangle, we got indecision in the market, people are sidelining because people are actually afraid because the market doesn't have any clear direction. That's sentiment, that's psychology. Okay, charting also assumes that any fundamental views of the market is priced into the market. Yeah, you know, if from a purely technical analysis perspective, that's kind of true. But if you start combining fundamental, then you'll start seeing that this might not be that true. Okay, the key aspect to successfully utilizing chart information is not to become good at predicting at what level you get in, what level you get out, and then boast it around. It's not about that. Okay, when you use chart patterns, when you look at technical analysis, the most important thing is actually to figure out what other traders are thinking, what other traders are looking at. Okay, I prefer to go with the majority. Simple as that. You know, when I started trading, you know, I tried to be different. I tried to go short when people are actually saying it's an uptrend. I don't want to go with the trend. It's stupid, right? I learned it the hard way. Blow up my account. It's not worth it. You know, once I start thinking what others are thinking, what others are potentially looking at, that's where it clicks. Okay, so when it comes to technical analysis, when we come to price action analysis, it's not how good you are at predicting these bounces on whatever levels. Switch it around. You're not predicting the market, you're predicting what other traders are thinking and looking at, and that's the key, right? Also to note, every tradable instrument has a very specific characteristics. So what you learn from pound USD is not going to apply to gold, because they are two different instruments. They have different characteristics, right? Even Euro USD and pound USD, they're majors against the US dollar. They have different characteristics, okay? And every instrument, they have a very specific price patterns that will occur more often. Like in sterling, you know, I trade sterling a lot. My majority of my trades are in sterling. They don't form ascending or descending triangle a lot. The Euro USD does that. Symmetrical triangles are what's formed in cables, you know, or sterling yen. I don't like them, but that's the reality of things. This patterns keeps appearing more often than descending or ascending triangle. You got Euro USD, you'll see a lot more descending ascending triangle in Euro USD. You don't see a lot of patterns appearing in dollar yen. You see a lot more of flag patterns and pennants in dollar yen. That's just how it is. So you need to understand what each individual assets has in terms of characteristics. Okay, so Q&A sessions. Any questions regarding the session tonight? I know I might sound harsh, but you know that's the reality of things. If you're not able to understand and draw trend lines correctly, you are screwed. Seriously, you're not going to be able to do technical analysis properly if you can't even get the basics right. Okay. Okay, so yeah, this is recorded. Thank you. Trend, what do you a good point to plot it from? I just show you a lot of good point to draw a trend. Maybe you want to review the power about what I talk about trend lines. You draw the trend line wrong, you're gonna get every trend wrong. Simple as that. This is for beginners, right? This is like super beginner. So this is really basic stuff, right? This is your ABC. This is your 1, 2, 3. So watch this, rewatch this as many times as you want. You know, it's gonna help you if you really get your basics strong. You know, I don't believe in learning a lot, right? I really believe in building your foundation. If you got your basics right, that's where you're gonna be consistent. It's not a matter of learning about maybe 100 indicators and then say, hey, I know everything about trading. It doesn't work that way. It's more repetition on the basic stuff. So yeah. Thank you. I'm in a better position today. Keep learning. That's very good. Thanks, Tony. Okay. So we are out of time. Don't forget that in 43 minutes time, Jerome Powell is going to give out a speech. It's gonna create a lot of volatility in the market. So be mindful of that. Other than that, thanks for joining in. Have a really great weekend, and I'll see you Monday for the Telegram channel, and everyone else I'll see you on the Outlook on Monday, as well as the live session on Wednesday. Okay, good luck with the trades. Hope this has been very helpful. If you like it, give a thumbs up. If you don't like it, or you got any other inputs, do comment on the video so we can provide you better education in the future. Okay. Midnight prayers was the best way to draw a trend line. Please rewind, because it's never going to be the closing time. Candlesticks or line charts, candlesticks or bar charts. Line charts is just one single moving averages. Okay, so always at the very high or the low, never the close of a candle. Okay, all right, guys, have a great one, and I'll see you soon. Yeah. Stay safe, stay healthy. Have a great weekend.